Theo Trade. This is Don Kaufman, May 21st, 2025. Here we are on a Wednesday afternoon. There's just over 20 minutes to go to the cash close. S&P is getting rocked to the tune of about 1.5%. A little degree of bond carnage, if you will, sparking some market mayhem. All right, let's get into it here, of course, on this Theo Trade evening update. Normally I'd start in the S&Ps, but it's not the S&Ps that really spark the sell side activity. It's the bond market. This is exactly what I discussed on the weekend update, that basically we're going to shift our focus. People are talking about the S&Ps and it's a rally and this stock is wonderful and there's, exuberance again over, quantum computing. Next thing you know, the bond market, the bond market was already having issues. But then today there was an auction that happened, bond auction. Results were not good. Market absolutely tanked, and what it did is actually spark some sell-side activity inside of the S&Ps. Don't get me wrong, the S&Ps were already down on the day, but this actually fueled some pretty wild sell-side activity. Nevertheless, the bond market, people, this is where it's at. The bonds are down 1 and 21 ticks. In fact, we're about to close again in a few minutes, and this will be the lowest closing price inside of the bond market since, well, roughly the beginning of the year. And for those of you that did not speak, if you don't speak Bond Geek, well, maybe you speak interest rates. The interest rates have spiked just in the last few weeks. And again, I just wanted to note this, from about 4.1%, again, down here is close to about 4.1 to hold your breath over here because that's about 4.6. So, everybody's like, well, the Fed should do this and the Fed should do that. Who cares what the Fed does? This is the 10-year, and the 10-year has rocketed. And that, people, is what's going to set interest rates and like mortgages, credit cards, basically everything you would do. But it's finally having a dramatic impact back into the S&Ps. And what's interesting about it, at least to me, what's interesting about it, it's hammering the financials, okay? More than it is tech at this point. And the way I look at it is, the financials, they like higher interest rates, right? They get to rip you off for more. They get more, yield in the spread out there. Nevertheless, though, tech is handling this rather well. And I wanted to point out, like Microsoft, down 1%. Apple's taken a little bit of a hit. Apple's actually down more than the marketplace, but that was actually true. Apple was already down before, some of the bigger sell side activity in here. But Meta, come on, it's down like 0.3%. It's not even skinning its knee. And the reason I'm actually bringing these tech stocks up immediately here, this is what I think is going to be opportunistic if some of this sell side activity is persistent, because it's stocks like Meta that have had not just a comeback. These comebacks have been absolutely stellar. Look at the upside over here. That's basically your up 33% for some of the recent lows. That's right now. It was up even more than that. We were up 38%, but right now, today, we're still up 33% from the recent market lows on stuff like Meta. By the way, that pales in comparison to stuff like Tesla, okay, and some of the rips back to the upside over here. So whenever we start seeing some sell side activity, okay, immediately I start to look for, well, if this sell side activity is going to be persistent, where do I want to position myself? Right now, it's looking like tech's going to be a pretty good place. If the sell side activity is persistent, tech could be a decent place to be short. And that's, right off the cusp, you can see it. Not necessarily Google. Google is a dramatic underperformer. Ironically, I'm actually long Google in a number of positions using spreads, but I'm long Google. And then I look at stuff like Netflix. Okay, it's completely unimpeded. This might be the most overbought beast in recent history in here. By the way, that most recent run is good for about 46%. I love pulling that up right now because it's wild, some of the moves that you're actually seeing on the screen over here. Nevertheless, as I said, some sell side activity, but how deep is the selling? Like, is this deep and cutting? Is it something I got to worry about? Well, coming into the cash close here, and again, we're about 20 minutes away from the cash close. The first thing that's important is this line, okay, in the SPX, and yes, we're looking at the SPX, the mother of all products. In the SPX, That's the lower edge of the expected move. And again, I want to be very, very specific about my levels in here. The lower edge in the SPX of the expected move. Let's label it here. And again, this is SPX, and this is the lower, okay? This is the lower expected move. What does it equal? 58.62. Again, 58.62 is the lower edge of the expected move. Okay, we hit it kind of reverberating back and forth off of it, but it looks like by the close, we may actually pull right back into it. And that is of critical importance because at that point, things are normal. And I said the exact same thing last week to the upside. You know, people are like, it is unprecedented volatility. It's not unprecedented. A little market mayhem, but that market mayhem was actually struck predominantly by the bond market. Can you imagine if the bonds continue to sell off? Okay, and they likely will. Then you got real problems inside of the S&Ps. In fact, I'm going to go ahead and go out on a limb. And I said this over the weekend video. I told you that it was going to be a focal point of the bond market. Okay, my opinion now, that these bonds are actually not done, not by a long shot. The bonds are actually going to continue to sell off. And in doing so, it's going to spark some real fear. And that fear starts to come by way of, for instance, like things like KRE. This is actually regional banks. They're getting freaking hammered right now. They're only down 3%, but it's one of the reasons the Russell is actually down 2.5% as well. But again, KRE, this is not something you want to look at buying right now. Okay, this has actually had a huge bid back. This could actually collapse considerably further. It's actually one of the reasons, though, that I believe the financials are down right now is that we could actually spill over from regional bank issues into the major. Some of the bigger banks out there start to take some considerable risk inside of the bond market. So again, the opinion piece over here is, look, I don't think the bonds are done selling. And I'm telling you right now, I have been selling bond puts. I'm going to continue to sell bond puts. I'm going in, very, very lightly over here, but I'll pick up a little bit of speed. Now, with the bonds actually selling off and interest rates continue to go a little bit higher. Again, what that basically does sparks a little bit of fear. Higher interest rates going to slow down the economy, and you get sell-side activity in the S&Ps. As I said, that sell-side activity is actually hitting the financials, okay, the energy sector, okay, but it's not hitting nearly as hard as I would have expected, as I said, in some of the big tech stocks, and that is what's going to be opportunistic. So those are areas I'm going to be looking. Stuff that's been high flying over here. In fact, I actually took a short position inside of GE. This is now GE Aerospace. Took a short position in here today. That one's actually playing very nicely for the crowd. By the way, take a look at this. We hit our own ghost print today, meaning that the volume was so significant that we did right here. The volume we did, which is approximately just shy of about 6,000 contracts, the volume we did was actually enough to basically come up under odd or unusual options activity. It's not unusual. It's me. It's Don. Nevertheless, let's actually get a bit of a read on volatility now. So VIX, okay, I know everybody likes looking at VIX. VIX is back over 20. I could care less. One of the other areas of risk right now that I want to pay attention to is VVIX. The VVIX got back to a pretty serious place. But here's the interesting thing. If you've noticed, okay, I haven't really gotten off much of the bearish bandwagon. Again, took a couple of bullish positions here and there. Notice the VVIX bottomed, okay, quite some time ago. But we have a pretty serious VVIX right now back at 105. It's not screaming duck and cover, but it sure ain't making me feel warm and fuzzy. The VVIX is up some 10% today. Pay very careful attention to that because, again, it starts to crack 110. It means the sell side activity is going to be a lot more persistent. The other thing that leads me to believe that volatility might be much more persistent is the advanced decline line. We went for it today, people. We're fully correlated. I mean, if you look at the advanced decline line over here, this is the S&P 100. Two of the stocks are up. It's Google and Google, right? So that really only kind of counts for one. But in the S&P 500, you kind of feel like, when they're buying like cigarettes, this is Philip Morris over here, when they're buying cigarettes, alcohol, I know Netflix is not alcohol, but it still amuses me. Coke, close enough. I mean, when you're starting to buy cigarettes and Coke, though, okay, it's actually pretty serious implications. We're just fully correlated across the board. The sell side activity, okay, is reverberating in the entire marketplace. As I said, though, there's going to be pockets of strength over here, and I think that's what's going to be opportunistic. On the bottom of my screen, I've actually got all of these ETFs from XLK to XRT. And the one thing I want to show you right now, I think it's kind of cool when you look at all of these ETFs packed together, okay? We're not smooth across the board in the sell side activity. It's like, XLP is only down 1%, but XRT is actually down 2.8%, but XLK is, which is obviously technology, is only down 1.7%. If the sell side activity picks up, you want to see this kind of flatten out, meaning that you see indiscriminate sell side across the board. All right, let's go back to the SPX. Let's go back to the SPX to kind of wrap things up over here. And again, to reiterate, in the SPX, the expected move for the entire week, the expected move was roughly 97 bucks. Okay, actual move thus far, well, look, you're just outside the expected move right now. So you basically moved, 105, 110 points. Okay, and again, the line in the middle of your screen right there, that's where the week started. Where are we right now? Lower edge of the expected move, and we're a bit outside of it. As I said to you, like, look, if those interest rates continue to go up, that is, the bonds continue to sell off, it's not going to be pretty for the S&Ps. But more importantly, what are we looking like the remainder of the week? As I said to you already, okay, I gave you my take. I think the bonds are going to continue to see some sell side activity. The other thing, okay, and this is not going to be pretty for the marketplace. I think China is going to start to take some shots at us. I don't think this trade deal is going nearly as smoothly as most might consider it. Okay, people think the deal is over. The deal hasn't even started, and they're already taking shots at us. Okay, the deal hasn't even begun. You think this is going to go easily? It's not going to go easily. We're going to be summer of volatility. It's the summer of George. It's going to be a summer of some volatility. The next, just 2 days, and I want to point this out, are still holding a crap load of vol. So we still have, what the market is pricing, $72 a risk just for Thursday and Friday. And why that's interesting? It's interesting because you're coming into a holiday weekend. All right, holiday weekend, you don't even expect anybody to show up to work on Friday. I mean, come on. This is the weekend where everybody actually empties out in Manhattan to the Hamptons. Okay, they're gone by Thursday afternoon, but there's still $72 of volatility. So, stop the helicopters from going to the Hamptons because we got trade. We got trade ahead of us. And we got some return of volatility, a little bit of market mayhem predicated on that bond marketplace. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.